Hello, this is Danielle, your local neighborhood Northern Virginia realtor.
This is Daryl Allen, certified public accountant.
So, Daryl, I have a question for you.
Yes.
Do you know what an assumable mortgage is?
I have never heard of that before.
So it's a hot topic right now because of where the interest rates are. So pretty much what an assumable mortgage is, it's only works for two lending types, FHA and VAs. And right now in this area, we're seeing a lot for VAs. Pretty much the way it works is if you're a homeowner, you're selling your home and you have a VA loan, your interest rate when you probably got into it was 2.5 or 3%. Let's just say 3%. And so now you're selling your home. You originally had a loan from a bank for $350, and then you've paid. You still have $250 left to pay. If I'm a buyer, you're selling your home. You can advertise that you have a VA assumable loan. So as a buyer, I would have to come to you and say, I want to purchase your home and I want to assume your loan. I have to then go to your lender, your original lender. I can't pick an outside lender. I have to go to your lender and I have to qualify with your lender for that VA loan. Once I do that and they say yes, then I can assume your remaining $250. However, let's say you're selling your home though for the $350 original price. There's a gap there of $150,000. I either, as the buyer, need to cover that gap in cash, or find a second lender to loan me that money. And this is where it gets tricky with people, that we always, as realtors, caution people. There is one, as of right now, that I'm aware of, lender that will do that here in the Northern Virginia. Any other lender you go to wants to be that first mortgage lender.
Now, what is the name of that particular lender?
It's called Towers Credit Union. That's local here in Northern Virginia. They will offer they will be a second lender. But if you go to any Chase or, First Heritage, Presidential, any of these big lending corporations, they're not going to do a second trust. So there's pros and cons. The pro is that a buyer gets into an interest rate a lot less than what they would have done currently right now. Also a pro is that if there's a house that has an assumable loan and they're selling it for, something where a buyer can come with just minimal cash for the gap and then have the rest of the loan, it's an easy deal because the lender has already pre-approved that person, so that underwriting settlement moves a lot quicker.
Mm-hmm. I think the way you described this program seemed like it's very awesome. It seemed like a very good program, especially in these days of time, because the cost of mortgages are so high. So if you qualify for the same mortgage as the person you buying the property from, mm-hmm. and you're able to obtain that same interest rate, mm-hmm. You just got to make up the other end. So that gap. So it's a possibility then that you will have two mortgages, right?
Correct.
One from the mortgage that you're going to assume from the homeowner, yes. And then another one that's basically going to be a part of that gap.
That second lender.
I think assumable mortgages is something that is great, that can really benefit the economy. What I'm wondering about, though, is what is the benefit to financial institutions for having these type of mortgages? Because if you just assume somebody else's mortgage, mm-hmm. right? Say if they got the mortgage from Chase Bank or whatever, mm-hmm. What is the benefit of Chase essentially transferring that mortgage into your name, right? Because if it's 3%, if the guy's paying 3% and they transfer it into your name and you paying 3%, well, technically Chase is doing work, but they're not really seeing that financial benefit of that.
So in that case, Chase is benefiting because they are not having to do extra work for a new loan. Their loan is still going to be paid, because what happens is for that 3% loan and that amount, it's still going to be covered versus somebody.
But they are doing work with transferring that mortgage into your name. That's not as easy as if just signing a piece of paper.
Yeah, you're right. Because you still have to qualify. A lot of lenders don't like the assumables. You're not going to hear a lender tell you about it when you're going into them. It's not a benefit for them because, again, no lender is going to be a second a second trust for you. There's, like I said, only the one thus far that I've come across here in the Northern Virginia area. And then it's there's that gap. No home is being sold for the amount of money to where a gap is less than $100,000. So you're talking about big portions of money that somebody would have to come up with. And then as well, for the buyer, you have potentially 2 loans. You're paying those 2 loans at the same time. So you have to still pay, your mortgage. Then your mortgage payment becomes a little bit more because you've got your second trust and your first trust, and you're paying them on a monthly basis at the same time. Mm-hmm. For VA loans, for the seller, you also take the risk, because if I'm not a VA person, you wouldn't want me to assume your loan, because you can't use your benefits. If you're a VA person and another VA person assumes your loan, then you get your benefit back as the seller. So it's tricky. There's some pros and there's some cons to it.
And then the more I think about this, is that it could cost banks money.
Yes.
And because when the original home buyer, they got the 3% mortgage, there is a built-in profit margin for the financial institution, right?
Yeah.
Maybe their cost of borrowing was like near zero, as it was maybe like 5 years ago.
Right.
With that 3%, they still have a little margin there that they could claim as profit. But if I'm coming in and I'm assuming somebody else's mortgage that is 3%, the cost of money it will take to pay off their mortgage is going to be very expensive now to the bank, because of the decrease in interest rates made by the Fed. So I really do not see a lot of advantages to financial institutions for having this type of program.
No.
And maybe that's why there's only one that's doing it right now.
Right.
And also, I'm wondering what is the scale of how they're doing these assumable mortgages, right? Because I'm thinking that they're probably doing this on a test run. Yeah. But they're not really. It's not going to be really scaled very large to handle many transactions.
Well, we're seeing it more again with the VAs, because the VA is already having that kind of. If the VA loan, anyways, you have a lower interest rate than you would conventional or FHA. Now, FHA was a surprise for me, learning that they are also allowing it. We don't see that often with FHA because, again, FHA loans already are a tricky animal. And if you are an FHA, if you approve for FHA, a second trust for an FHA loan is almost near impossible, because, again, the bank doesn't want to have to take that risk. So it's something that we get some buyers. I think it's the education to the buyers to understand exactly what goes into that, education for the sellers. But then also knowing that it's going to be very hard for you to get a second loan on a home. And these homes, and another thing, if you think about it, when the person bought the home, it was at one price. Especially in Northern Virginia area, homes aren't depreciating, they're appreciating. So somebody's not selling their home for what they bought it for. So now the bank, to assume that loan, but the price of the home is a lot more. So the seller's going to want to sell their home to get some money back versus taking a loss on that. Plus, you got to make sure the home is going to appraise as well. That's a whole nother animal.
Yeah, there's a whole lot of moving parts to this. Yeah. And I'm pretty sure we're going to kind of revisit this discussion in the future, because I'm very curious if this assumable mortgage type of program is going to take off and spread to a lot of financial institutions. But please stay tuned, because we'll revisit this again soon.
Thank you. Thank you.